What if you had just $1,000 in 2020, and instead of letting it sit in your bank account, you put it to work? Where would you be today? Would that money have doubled, tripled, or would it be gone? Lost in hype, another get-rich-quick dream. Today, we're doing what most financial channels don't. We're looking back at the real numbers over 5 full years across 3 very different assets: Bitcoin, the digital wild child of finance; gold, the traditional safe haven; and Rolex watches. Yes, luxury timepieces as investments. And the results? Let's just say you're going to be surprised by which asset actually gave you the best balance of risk and reward. But more importantly, what this says about how you should invest going forward. So let's rewind to 2020. Not just any year, a historic turning point. A global pandemic shut down entire economies. Supply chains collapsed. Unemployment exploded. Central banks began printing money at record speed. Governments passed multi-trillion-dollar stimulus packages. Interest rates were slashed to near zero. And inflation? It was just getting warmed up. For millions of people, it was a wake-up call. Money sitting in a savings account suddenly didn't feel safe. It felt like it was quietly evaporating. Everyone from seasoned investors to complete beginners started asking, where do I put my money now? And so began one of the most dramatic shifts in investment behavior in modern history. Risk appetite changed, speculation soared, and the rise of alternative assets took center stage. Let's start with the most explosive asset of the decade, Bitcoin. In January 2020, Bitcoin was trading at around $7,200. At the time, many still dismissed it as internet magic money, or a bubble that already popped back in 2018, and it started to climb. By the end of 2020, Bitcoin had already crossed $29,000. In 2021, it hit an all-time high of over $65,000. Yes, it crashed after that multiple times. It lost more than 50% of its value, more than once. But zoom out and the picture becomes clear. Bitcoin didn't just survive the chaos, it thrived. Today, as of 2025, Bitcoin is hovering once again around $65,000. That means if you had invested $1,000 in January 2020, you'd be sitting on over $9,000 now. That's a return of more than 800%. Of course, let's be honest, Bitcoin isn't for the faint of heart. The ride was bumpy, emotional, terrifying at times. You had to sit through major crashes, fear, uncertainty, media hysteria, and relentless debates about regulation. But if you believed in the long-term story, it paid off, big time. Now let's talk about something older, more stable, more golden. Gold, the original store of value. For thousands of years, civilizations have turned to gold in times of uncertainty, and 2020 was peak uncertainty. At the beginning of 2020, gold was priced at about $1,500 per ounce. As the pandemic unfolded, investors flocked to safety. By August of that year, gold hit a record high of over $2,000. Since then, it's remained relatively strong. Today, gold is trading around $2,300. So what would that mean for your $1,000? It'd be worth around $1,530 today. Not bad, not amazing, just solid. Gold didn't 10 times. It didn't crash either. It did what gold does best. It preserved value. During one of the most chaotic 5-year periods in modern financial history, it held the line. If you were looking to protect your purchasing power without gambling, gold delivered. But now, let's look at a completely different kind of investment, one that most people never think of seriously until they see the numbers. Luxury watches, specifically Rolex. Now you might say, that's not an investment, it's jewelry. But in the past decade, Rolex watches, particularly iconic models like the Submariner, the Daytona, and the GMT Master 2, have seen dramatic increases in value. And not just because they're shiny, it's about scarcity. Rolex deliberately underproduces. Demand always outpaces supply. And during the pandemic, when supply chains froze and inflation kicked in, the secondary market for Rolexes exploded. Take the Submariner, for example. In 2020, retail price was around $8,000, but most people couldn't get one at retail. They were going for $10,000 to $11,000 on the resale market. Today, that same watch goes for $18,000 to $25,000, depending on condition and model. So let's say you didn't buy a full watch, but you invested $1,000 through a fractional platform or into a luxury watch investment fund. That share could now be worth $2,000 to $2,500. Why did this happen? Simple. Rolexes are more than just watches. They're signals of status. They're collectibles. And as fiat currencies lost purchasing power, collectors and investors started turning physical, finite goods into financial assets. So let's recap. $1,000 invested in Bitcoin in 2020. Over $9,000, $1,000 in gold. About $1,530, $1,000 in Rolex. Up to $2,500, depending on model and timing. 3 assets, 3 stories, 3 completely different risk profiles. Bitcoin was high risk, high reward. Gold was low risk, low reward. Rolex sat somewhere in between, steady growth with strong cultural value. Now here's the part most people miss. This isn't just about returns, it's about what those returns represent. Bitcoin rewarded belief in disruptive technology and decentralized finance. Gold rewarded caution and preservation. Rolex rewarded an understanding of culture, scarcity, and the psychology of status. This isn't just a comparison of numbers, it's a lesson in investor mindset. And here's the real takeaway. This wasn't about luck. Each of these assets followed a clear narrative. Bitcoin grew as more people lost faith in fiat. Gold rose during inflationary pressure. Rolex soared as physical assets gained favor and collectibles became financialized. So the question isn't which one should I have picked in 2020? The question is, what's next? Because here's the hard truth. The next 5 years will not look like the last 5. Interest rates have changed. The crypto space has matured. Inflation is sticky. Geopolitical tension is rising. AI is disrupting everything. And new kinds of assets, like tokenized real estate, fractional ownership platforms, even digital collectibles with utility, and are entering the mainstream. So, what should you do with your next $1,000? Should you gamble on the next Bitcoin? Should you play it safe with gold or index funds? Or should you look for alternative assets, ones that combine scarcity, utility, and long-term cultural value? The answer depends on your strategy. If you're chasing hype, you'll always be late. If you're following the crowd, you'll always be reactive. But if you build a portfolio around your goals, your timeline, and your personal risk tolerance, you'll be ahead of 90% of investors out there. The truth is, building wealth isn't about timing the market. It's about time in the market. It's not about finding the perfect asset. It's about building a system that works for you consistently over time. So what are you doing with your next $1,000? And more importantly, what story will your money tell 5 years from now? If you're ready to stop guessing and start thinking long term, hit that subscribe button, because on this channel, we don't just follow trends, we decode them. Let's make your money work smarter, not just harder. See you in the next one.